This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on to the Postgame chart deck, which this week is titled Post-FOMC Postmortem. Registered users, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email in your inbox, that means you haven't yet signed up for a completely free account at macrovoices.com, which you can do by going to our homepage and clicking the red button that says Looking for the Downloads. Patrick, we're looking on page 2 here at the S&P continuous chart with the 50-day moving average under it. What's going on?
Well, we were in the last couple of weeks and going into the FOMC in the quad witch and gamma pin period where volatility is compressed and we had these average 20-day S&P point ranges for high lows, and really things were quiet. And one of the themes was that in the post-quad witching roll-off that the volatility would return. The question we were trying to ask, though, would that volatility be some big move to the downside or simply finally a market that's unpinned to continue a trend higher? And what's interesting is that we started that Friday with a quick drop that followed the textbook drops that we have seen in the last 6 months, which is it consolidates down to an average point, in this case the 50-day moving average, which was also about a 50% retracement of the prior rally, immediately found support. Buy on dip traders came back and immediately punched it back to 52-week highs. And so we have the prevailing uptrend still quite intact. And the big question right now is, are we about to see that S&P 500 punching that 43 or 4,400 on the upside and finally get another kind of 5% kick to the upside on the S&P? And while the S&P is doing that, really I think the story is actually when looking under the hood in terms of what is driving this. And so it's on page 3 that I have that Nasdaq 100 chart. And while the S&P is toying with a breaking to a 52-week new high, what we can see here is that the Nasdaq has broken a 52-week high and has been staying up there over a week now as we see relative strength in the Nasdaq. And what's interesting about that is that where is that relative strength coming from within the Nasdaq? And that's in the FANG stocks. And so when looking at page 4, we can see that while the FANG stocks during that since the start of the year essentially have been materially underperforming, and while the cyclicals and financials have been roaring higher, almost all of those FANG stocks, everything from Apple to Amazon to Microsoft, have just been far more range bound and chopping around. But what's really interesting in the last month is that we have seen these FANG stocks roaring using this FANG+Index Futures up about 17% in the last month and been the relative strength outperformer amongst the sectors. And that really is an interesting change of events, because ever since the reflation trade kicked in back in November, where almost all of the performance has been, at least outperformance has been in being long financials and long cyclicals and long value. And what we really seen is that in the post-FOMC period, when we saw the yield curve get hammered and yields getting pressed down and a lot of these commodity markets turning over, suddenly, just like Harley Bassman was talking about these FANG stocks being like 70-year duration bonds, now when we see yields coming back down, it seems that there's rotation or sector rotation back into these kind of growth names. And this is one of the big questions to ask is, are we seeing this rotation now going to be a sustained new trend, or was it just these oversold conditions and suddenly this like a elastic that's been stretched too far? This is just like a reactionary snapback, or is this a bigger trend? And I think that's such a big puzzle piece to solve here in the coming weeks.
Patrick, we look a lot at the gold charts. Let's take a look more broadly at metals and mining, not just precious metals, but all metals and mining. That's represented by the XME ETF on page 5.
Right. And so this is where I really wanted to point out that what was working during this reflation trade and where the big question mark is that you can see that since November, this metal mining ETF has been just on a tear, up pretty much 100% since November. And really, you can see in the post FOMC was the first legitimate sell-off that we had in a while. And similar to sell-offs that we saw in January and in March, almost immediately they got bought on dip and they quickly rallied back. And I think one of the biggest things that I'm watching into next week is that was this a more meaningful change in trend, or was this a big buy on dip? And I don't know if I'm ready to stick my neck out definitively and make a bold call here, but it's really up to the bulls here to quickly recover this back up toward their highs to keep it going. A failure and continued consolidation in this space in the coming weeks will really start to solidify that some kind of bigger sector rotation has really gotten underway. And when we look at page 6, where I have the financials ETF, the XLF ETF, you can see the reaction was the same. The first initial highs on both the financials and on the metals and mining all came on those really high CPI prints. But really, when the FOMC took their hawkish tilt was where they all broke badly. And whether this was just a short-term noise and an overreaction, or whether it's a change in trend, is 100% the question I'm trying to solve.
Well, I'm going to give you my answer to that, which obviously is totally opinion and could be wrong. But as I look at almost all of these charts, whichever page, I'll just look at page 6 because it's in front of me right now. They all look the same to me. What I see is to the left of June 1st, I see a trend that's driven by the fact that most of the major governments around the world are in over their heads in a money printing experiment that is a no way out situation ultimately, but we're a long way from the final end game. And then I see for the last few weeks a handful of people that were stupid enough to think that when they said they might tighten that they actually meant it this time. And it actually took the market down for a good whole couple of weeks before people came to their senses and realized that that's crazy and governments are going to continue to recklessly print and spend beyond their means just like they always have, which means that this reflation trade is going to continue. So if the reflation trade just ended because of the FOMC statement, I'm going to go double, triple, quadruple out on a limb here and just say I'll be super duper wrong if it turns out that what really happened is the reflation trade is over because central bankers turned responsible and intend to stay that way. I don't buy that one.
Well, you know what? I certainly won't rule that out, but I'm gonna read the tape and see whether or not the price will be confirming your view. But let's move on to the dollar index on page 7, because I really wanted to visualize what we talked about it in the market wrap at the beginning of the show. I mean, what we're really showing here is that since the start of that COVID period back in March 2020, there's been more or less an incredibly pronounced downtrend in the dollar. The dollar bear has really kind of very distinctly worked its way lower till the start of the year. But really, the last 6 months of 2021 has been far more of a sideways trade range rather than a downtrend. And this is why I think the dollar is going to give a big tell here. I mean, you were right that that kind of 89 to 94 zone is sort of one big trade range, and we've seen the highs and lows within there, and we're pretty much right in the dead center of that range. But will the dollar be able to muster up a more pronounced breakout out of this sideways trade range is one of the kind of big puzzle pieces to solve into the back half of the year.
Let's take a look at gold on page 8.
Yeah, really all I wanted to point out on gold here was just how distinctive a drop that was that happened last week. And really, while, you know, a lot of people are getting nervous about the gold trade very quickly, just on a one quick bad break, but I think it's incredibly premature to be defining the next big trend move after that reaction. I think one of the key things I'm going to be watching for, I think gold can easily bounce to like 18 and a quarter to 1850 on a reaction, but will there be a sustained buy on dip that develops here on gold, or does this turn into a distribution cycle that goes and retests those March and April lows? I think that the tell will come once we get a bounce, and we'll see how the bulls behave on that turn.
Well, needless to say, the technical analysis is the way to watch this. But if you want my gut feeling, I say gold goes down, 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 until people who are not able to see the big picture start to see the picture, come to their senses, and realize that gold needs to go up, 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 up. Not everybody, including really smart people who are good at details, understand big pictures, and I don't think most people get it. I really, really, really think that this is one of the best secular trades of our lifetimes, Patrick. The central bankers are going to make gold worth more, and people are going to get, I think, spooked out in the meantime thinking it's worth less, and that's just a great buying opportunity. So I'm crossing my fingers for lower numbers.
All right, well, let's move on to crude oil on page 9. The one thing that I really wanted to highlight, because we're going to put up a chart here on copper, and we're going to put a chart up on lumber, and even I don't have charts up here, but if you look at the grains or right across the entire commodity complex, we basically see crude oil still very distinctly in this bull trend higher, and it's an uninterrupted, very clear bull trend that remains in place. But other than the little quick pop we've seen on RBOB gasoline that joined the crude oil party on the upside, we really have seen the rest of the commodity complex correcting on the downside. And I asked the question, I mean, can crude oil, first of all, just kind of march to the beat of its own drum and really not play along with the whole commodity complex? Or is crude oil just delaying on this? I mean, at this stage, the trend very distinctly points toward higher crude oil prices, but that divergence from the rest of the commodity complex leaves a big question as to what's next here. And I think that on the short term, I'll be watching whether or not the bulls can sustain these higher highs in crude oil in the coming days.
Patrick, let's move on to copper futures. I've been thinking about this one a lot. You know, the macro argument for why copper keeps going much higher is really strong. But boy, the argument for look how far it's already come. You know, new money buying new longs now, kind of hard to justify, but I want to. What do you think?
Well, this is the interesting thing. Like the high of copper pretty much came in on that really hot CPI print and broke really badly on the FOMC. Now, the one thing that we can definitively say about copper is when it was near its highs, it was single-handedly the most consensus trade out there. I mean, finding anyone that was making a bearish copper argument, it was very, very hard to find anyone that would stick their neck out there. But what we really have seen now is a shift in the trend where typically where you would see a buy on dip on copper, which should have come around 450, that broke quite definitively on the downside. Now, I don't want to already suggest that copper is going to do something outright bearish, but often these commodity cycles can last many, many months. And if we've seen kind of peak sentiment and peak short-term copper prices, the question here is are we seeing this not as a multi-week correction, but a multi-month correction? And if that's the case, will we temporarily see copper back under $4 to create another good buying opportunity down the road? So, you know, this is, again, just shows how many of these copper plays, including, you know, the copper has been pressured lower by China, at least verbally, you know, them talking about trying to bring these commodity prices back under control. It'll be interesting to see whether that will end up being a key high there. And another example of that is in lumber prices on page 11. You know, lumber was one of the most inflationary forces out there back throughout the first and going into the second quarter of the year. But after lumber just going parabolic to 1,700 on the upside, I mean, this is as clear of a breakdown of that bull trend as you're going to get. I mean, we had a 50% wipeout in lumber prices in just 2 months off of those peak levels. And that just kind of shows just how divergent oil is from the rest of the commodity complex that has really already been distributing. And it'll be really interesting to see what the knock-on effects of this kind of a shift are. The one thing that I'm going to be watching for sure is if for whatever reason, if oil's given a catalyst to begin a correction, that could definitively turn the commodity index futures, because when you look at something like the Bloomberg Commodity Index, it's so heavily weighted into the energy that the uptrend in those indices has been very distinctly higher, largely because oil's holding up. And this is why I think oil is going to be such an important market to watch here in the coming weeks.
Patrick, I don't mind admitting that where Treasury yields are headed has been a mystery to me. I don't believe in the meltdown scenario some people fear, but I don't know either. What do you think? Where are we headed, not just next week, but long term?
Well, it's interesting because the inflation theme has been so dominant, and while there's no denying it, I'm not trying to say that I'm against the inflation storyline. But what is interesting is how bonds no longer seem to be nervous about it. I mean, I've heard a number of people, whether on Twitter or some really smart guests, that have been talking about the decoupling of yields from inflation, and obviously that's going to influence gold because of real yields. But one thing for sure is that we're now 3+ months into yields just consolidating and backfilling on the downside. And this has been doing it through some of the hottest inflation print numbers that we have seen in years. And I continue to think it's really interesting, and particularly on the hawkish tilt, if we go back to or go to page 13 when we're looking at the 5/30s yield spread, you can really see, we wiped out 6 months of steepening on this curve. And what's interesting is you would think that we would at least get some sort of a meaningful reaction bullishly on the upside, and we find ourselves still trading very close to the bottom end of this range. And it really shows that the bond market is saying something different is happening here. And I just don't want to ignore this. I mean, definitely the bond market is taking the Fed a little more seriously than a lot of people who are trying to already say that it was just noise.
And listeners, don't forget, if you enjoy Patrick's chart decks, you don't have to wait for MacroVoices Thursday night. You can sign up for a free trial of Patrick's service, Big Picture Trading, and get a webinar with Patrick every single morning. You'll find information on page 14 or at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.